Thank you, Elaine, and thank you to the organisers of the conference for permitting me to share some musings on the mining sector today. As you said, my name is Ross Alistair. I look after the mining team at Peel Hunt. To give you some context, Peel Hunt's a UK-focused investment bank. There we go. We're retained corporate advisor to 148 companies listed on the London Stock Exchange. Average size is around about £1 billion, and we're one of the most active banks in the UK for raising capital, as well as being a major liquidity provider in the equity market. As head of the mining team, I've got the privileged position of acting for companies that responsibly extract commodities across 5 continents, and they'll play a central role in the energy transition. I've got access to super smart analysts. I've got the opportunity to interact with investors, and I also engage with government and regulators. Last year, I presented at this conference and I shared some high-level thoughts on the global economy in what felt then like a new era. It was just after Trump's first 100 days in office, and he just instigated significant tariffs, which were causing a fair amount of consternation in global markets. But I presented on effectively what's going on in the global economy, how that relates to capital markets, and in turn to the mining sector, and then individual companies that produce or aim to produce metals and materials. Today I'm going to update that analysis to reflect current dynamics, reflecting the conflict in the Middle East and Ukraine, and how that relates back to the markets. So last year, we were in a fairly turbulent situation, to say the least. The tariff discussions from that point kind of pale into insignificance to an extent when you kind of compare it to the prospects for global conflict and supply chain disruption that we have through the Iran conflict and the disruption in the Straits of Hormuz at the moment. My first 2 graphs, I like graphs, and there's going to be a few of them. First 2 graphs demonstrate the broader challenges that the global economy faces right now. The world's 2 largest economies, the US and China, account for 29 trillion and 19 trillion respectively, and not far off 50% of global GDP. In the US, regardless of having a new chair, the Fed continues to walk a bit of a tightrope under significant scrutiny and political pressure. When there's concern around global growth or growth outlook, investors and governments typically look to central banks to act aggressively and utilise monetary policy to provide stimulus to the economy. The key challenge right now is that we have an unhelpful mix of slowing growth concurrently with rising inflation expectations. And you can see that in the graph on the left-hand side there. The reason the Fed's obviously acting cautiously is because they're walking that tightrope between providing that stimulus, which Trump would love, obviously, and while being very cautious about the risk of inflation and the potential scenario of ending up with stagflation, which would obviously be incredibly detrimental. Over in China, and the right-hand side graph, there's been continued increase in stimulus, not necessarily in response to trade wars or the conflict in Iran, but because of a chronic lack of consumer confidence. There's a number of reasons for this. Firstly, they had and you can see that in the bottom right-hand corner as well. The yellow bars are Chinese economic policy uncertainty. China had a very challenging experience during COVID. It then emerged into a real estate crisis. And more fundamentally, it's grappling with the transition of moving from an emerging economy into an established, wealthy global superpower. Poor economies benefit from selling stuff. As the economy grows, then goods then become more expensive, and there's a shift towards more domestic consumption. That transition is obviously challenging. It shouldn't be forgotten that China is a global economy. It produces goods that are sold around the world, and so it's significantly impacted when global trade and global demand declines. The biggest consumer of Chinese goods is the US. So you have the world's 2 largest economies butting heads and competing for geopolitical supremacy. One is a producer of goods and one is a principal consumer of goods. So we've got an uncertain economic outlook, declining growth numbers, increased inflation indicators, policy uncertainty at unprecedented highs. Anyone who's probably heard me, Jeremy, I can see you speak at other conferences. I've been accused of being quite gloomy in the past. But I think there's a couple of reasons why I'm probably not as downbeat as potentially this slide indicates. Firstly, you should never doubt the resilience and ability of mankind and markets to adapt. And secondly, this isn't necessarily a bad environment for mining companies. Most global economies are investing significantly in industrialization, which we haven't seen for a number of years, at least not on a consistent basis. The conflict in Iran as well has been another reminder, and we've had a few in recent years, for governments and for economies to focus on supply chains and focus on how the security of materials and minerals that for frankly decades we've taken for granted. I spoke last year about the fact that industrial commodities had declined in price at that point, but the outlook for copper and most industrial commodities I thought at that time remained fundamentally very strong. I also spoke about the gold price and the dynamics that I thought were very positive at that time. And both factors remain and are probably stronger than they were at this point last year. And I think most commodities have performed very strongly, which I'll come on to. The other point that I'll touch on is the rollout of AI has been increasingly focused on infrastructure and hard assets, which is going to be another new driver for commodities going forward and for markets. So how is this impacting markets? The graph in the top left here shows the US dollar deflated by US CPI versus all currencies that the US trades with. So this ultimately shows the true value of the US dollar and hence the strength of their economy and their markets versus the rest of the world. And effectively, you can see three distinct periods here in terms of the spikes in the black line. The first was the late 70s and early 80s, driven by Reaganism, by deregulation and the oil boom. This was then reined in not necessarily because the US wasn't performing particularly well, but rather because the rest of the world was catching up. We had Thatcherism, we had the Big Bang with the Gulf War. And the next big rise is the tech boom in the 90s and early noughties, followed by that bubble popping. That was amplified by 9/11 and a period where China and the rest of the world was growing at consistent and elevated pace. Then we had the financial crisis and the US had a better recovery, less over-regulation compared to other markets. And that was followed by the second tech boom, which has had a massive gravitational pull on global capital flows. The top right shows that there's been a rush to secure supply of materials in recent months, obviously, in part in response to the closure of the Straits of Hormuz. This is a specific Iran impact, and it's either going to moderate over time or it will probably kind of come back down depending on the outcome of the conflict. The bottom right graph demonstrates that capital markets, I'm not sure you can see the grey lines, which is a bit annoying because that's the key part of the graph, but fundamentally, capital markets on a forward 6-month basis are a great predictor of industrial and trade flows. So I think if you could see it, you could see that the lines here will effectively be a predictor of where the market's going to go. The general point I'd make on this is that we haven't had a proper and consistent industrial cycle since Russia invaded Ukraine. The necessary conditions for good market, for IPOs to come back, for fund managers to adopt a risk-on approach is a consistent period of growth and of global trade. The other kind of interesting point and pertinent point at the back end of this graph, if you could see it, is that the markets are currently pricing in a tackle trade. They're predicting a short-term resolution to the conflict that we currently face. The markets haven't been as significantly impacted as you probably would have thought, given the importance and the disruption that we're seeing to the supply chain. So just touching on Iran, it's obviously created a significant supply shock. We've seen severe disruption and in some cases destruction to Middle Eastern energy, commodities and manufacturing industries. The scale and duration of the shock remains uncertain, but shortages will accumulate over time. The world consumes 100 million barrels of oil per day. There's about 20 million barrels of oil per day which are being disrupted right now, which is equivalent to the US daily consumption. This impacts all energy-intensive sectors: pharmaceuticals, travel, agriculture, chemicals, tech, mining. And there's 3 stages of this shock. So stage 1, prices rise, but disruptions are avoided through the utilization of reserves and inventories. That's the first 6 to 8 weeks, which we're probably approaching the end of. We're now probably in stage 2, which is where shortages emerge and they hit economic activity. Recession worries are obviously going to grow. And then there's a stage 3, which is where financial system dislocates. You see rising default risks and you see credit problems. Our in-house economic analyst sees 3 potential broad outcomes. There's a base case, which is the market, which effectively is what the market is currently pricing in, where where we have slower global growth. So there's revisions to global growth predictions for this year, plus higher inflation with aftershocks for around 6 months. A prolonged war risks a global recession, central banks struggling to ease policy or rate hikes. Or there's an upside case where there's a quicker resolution, central banks support demand and markets rally strongly. Risks, I think, currently remain skewed to the downside, and we're suffering from daily fluctuations in sentiment, generally due to Truth Social tweets, etc., and thus relatively extreme volatility in capital markets. But that said, I think because of the tackle trade, because of the perception of the markets right now that there will be a resolution, deals are still being done, capital remains available, and markets continue to function, albeit at a slightly less than normalised rate. So relating this back to fund flows and market valuations is where I think things get interesting. The conflict in Iran has put on pause a trend that was developing at the start of this year, which I was talking about last year as well, which is the decline to an extent in US exceptionalism. The US outperformance has been driven by high growth AI companies, which are reliant on infrastructure to build out to achieve their goals. The top left-hand corner shows the ratio of value in the stock market relative to the value of the US and UK GDP. So you can see there's obviously a significant divergence as market valuations in the US ramp up significantly. Effectively, it's a proxy for fund flows because it demonstrates that the US market has attracted international as well as domestic capital incredibly effectively in the last decade. The relative valuations on a simple PE basis have diverged, and the same is true in most jurisdictions, not just the UK. I think if you compare the US market to most other domestic stock markets, you see a similar picture. The 7 largest tech companies in the US account for 21 trillion in market capitalization. That's more than the UK and the European stock markets, every single company combined. The global market capitalization of listed mining companies is around about 3.4 trillion. So these companies trade on significantly higher multiples because of the assumed future growth of their businesses. And the big change that I mentioned before is that AI is increasingly focused on hard assets. Last month, Google and Amazon invested $45 billion in Anthropic because it publicly admitted that while its code and the backup to the AI functionality was performing well, it didn't have enough compute. Compute is effectively the physical infrastructure required to enable it to continue to grow. So that is data centers, AI, and the infrastructure that enables the AI fundamentally. Anthropic alone is now forecast, their capex is now forecast at over $100 billion for this year. That's one company. The combined hyperscaler capex of all of the AI companies for Q1 of this year is $130 billion. So we're talking about significant numbers, and the minerals that enable this are, the delivery is not optional. They're going to be a gating item here. So this means higher commodity prices, higher multiples for mining companies that extract commodities, and increased capital availability for those companies. So coming back to the slide, again, my grey bars are not showing, which is a bit frustrating, but I can make the point anyway. I think the point that I would make here is that we've been here before. The bottom right graph shows the difference between the S&P and the FTSE going back to the 90s. And you can see divergences. The grey bars would show how pronounced those divergences are. But effectively, again, you look at different periods. So in the 90s with the tech boom, the US market outperforms. You then have a period during the noughties where, as I said, China growing at increased rates, UK markets probably outperforming. The UK actually traded at higher valuations than the US market. And then we have the AI boom, which kind of shows the US markets taking off and the divergence being quite significant. But the divergence, if you look at it on relative terms between the tech boom in the 90s and the current position we're in, is very similar. So the point I'd make here is that markets are generally efficient. Over time, they consistently mean revert. They're also, like the mining sector, very cyclical. So you would expect over time that things will revise back down to normalized levels. The UK has an industrial index, fundamentally. We're exposed to hard assets, defence, other kind of defensive sectors. So we should benefit from a halo trade, and we were at the start of this year. I think people who analyse financial markets love an acronym. I'd like to invent a new one in honour of a hero of mine, Billy Connolly. He always spoke very affectionately about a certain word that's got a lot of flexibility when it's used in the English language. But I apologise to the conference organisers for the profanity, but I call it the give a fuck trade, or gaff. I think investors in the UK haven't needed to gaff about the mining sector for a number of decades now. It hasn't made up a significant proportion of the index. They haven't needed to care, and frankly, we haven't been particularly exciting. That's changed. It's changed over the course of the last year, and I think the key thing that investors care about fundamentally is performance. What changed last year was mining companies significantly outperforming the rest of the market, and therefore if you didn't have exposure to the sector, you missed out on performance. You were forced to gaff. Last year and at the start of this year, our mining analysts and our sales team were inundated by generalist guys that hadn't had any exposure to the sector, needed a teach-in. They needed to understand the commodity dynamics, needed to understand who the listed companies were, what the drivers for their stocks were, etc. So we were in a very, very strong position, and then the conflict in Iran came up, and it's kind of moved us back a little bit, but I think that the dynamics are still there. Historically, though, London has been the epicenter of investment into the mining sector. We remain home to many of the world's largest mining companies, a lot of the private equity funds that invest in the sector. And when we've seen periods like in the graph in the bottom right, where the FTSE 250 outperforms the S&P, London provides an outsized allocation to the sector. I believe that we're moving into one of these cycles, and the outlook's now more positive, notwithstanding the complexities that we're currently facing. Capital was being reallocated as well, is the other point. The US markets, as you can see, I mean, it's around the edges, and maybe I'm grasping at straws a little bit, but you can see the US market coming off. You can see the valuations of US companies coming down. That's slightly moderated because of the conflict and because AI keeps growing. But there is a trend that is developing, and maybe I'm clutching at straws or talking my own book, but I think it's one that's going to continue. So what I've spoken about so far is principally on the demand side drivers for the global economy and commodities. If we flick to look at the supply side, the impact of the closure of the Straits of Hormuz has been significant. It's another reminder to the West of the fragility of our supply chains and our reliance on other countries to provide commodities and products that fuel fundamentally our economies. At the same time, we continue to have huge reliance on China for key materials, particularly in the critical mineral space. The graph on the right shows the current commodity prices as a percentage of their 12-month high and lows. So you can see precious metals on the left-hand side generally are trading at the midpoint of the range. That's because they had a fantastic rally. There was a momentum trade, and there was a rush to liquidity when the conflict kicked off. That's not necessarily what you would naturally think gold and silver prices are going to do when there's a significant conflict, but it was because of the dynamics in those metals leading up to the conflict. If you look at pretty much every other commodity, we're trading at close to 12-month highs. And those 12-month highs are probably close to all-time highs for a number of those metals as well. That's because of the demand drivers that I've already spoken about, but it's also because of supply constraints. The graph on the right-hand side is really indicative of the fact that we are struggling to discover new sizable assets. This shows effectively the number of plus 2 million ounce discoveries in the gold space going back for the last couple of decades. And it's obviously declined significantly, whilst exploration budgets have generally trended upwards. The same is true in copper, the same is true in multiple other commodities. Mining companies now have more access to capital. They're making more money, they're drilling more, they're paying dividends, they're developing assets, and they're still having cash left over. So this trend, I think, potentially reverses, but there's a lag. And I think we talk a lot in the industry about that not just the lag for finding the capital to then go and drill, to then find an asset, and then the development timescale to develop any asset is generally 10 years as well. So supply doesn't respond quickly is ultimately the point that I would make here. So some key takeaways from my perspective. The global economy remains in a very challenging position. We're currently pricing in a tackle trade. There's going to be a lot of eyes on whether or not the conflict's resolved in the next few weeks, because I think that's going to be a big indicator for markets. Notwithstanding that, there's going to be a significant focus on reindustrializing Western economies almost in any scenario, and therefore mining should be a net beneficiary. US markets outside of AI are actually showing signs of weakness. The software sector is struggling in a way that wasn't necessarily predicted. And capital is going to be reallocated to other markets and other sectors. Mining is going to be a net beneficiary, will benefit significantly from the requirement for AI infrastructure. Don't believe the headlines on the UK market. We're actually in a relatively strong position, and we're going to benefit from a halo trade due to the industrial and defensive nature of our index. Generalist investors are beginning to gaff. And finally, I'm always cautious about using superlatives in an audience of mining people, because I think we have a tendency to get a little bit overexcited in our little echo chamber that we have in the sector. But I do think we're in a stronger position as a sector than we have been for a long, long time. So I think the outlook's very positive. Thank you very much.